There are many different styles of investing, and two of the most popular are growth investing and value investing. Growth investing is when you buy a stock which is growing its earnings very rapidly, and its price should increase very rapidly to keep in line with its earnings. Value investing is when you buy a stock which is undervalued relative to its fundamentals. That might be its price to book value or its price to earnings value, which is too low. And then it comes back in line with the market and you get a capital gain. Now, there's been a massive shift in the balance between those two different strategies recently. So to see why, let's look at that in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. The choice faced by most investors is whether they should buy the market or try and beat the market. If you want to buy the market, then you'd probably just track the MSCI All Country World Index or another global index. This would capture about 85% of the global equity opportunity set, which isn't all the stocks in the world, but it's a very large proportion of them. And if you want to track that index, there are many exchange-traded funds which can do that. And the cost, or the total expense ratio for doing that, is very low. It can be as low as 0.12% per year. The other alternative is to try and pay someone to outperform that global index, and you'll pay much more than 0.12% to try and do that. But good luck trying to find a manager that can actually outperform. The S&P Index versus Active report, or the SPIVA report, tracks this over a very long period of time. And for global equity funds, which are sterling denominated, only 8% of the funds manage to outperform their benchmark over a 10-year period. And that means it can be very difficult, if not impossible, to identify funds which can outperform over the long term. An alternative way to outperform is based on the ideas of these two men, Eugene Farmer on the left and Kenneth French on the right. This was their 1992 paper, which looked at the factors that determined stock performance. Based on that paper, and many papers since then, researchers have identified different types of stocks which have outperformed the general market. So small companies generally outperform large companies by around 4.5% per year. Other factors include liquidity, so low liquidity stocks which are more expensive and take longer to buy and sell tend to outperform the broad market, as do cheap stocks versus expensive stocks, upward moving stocks versus downward moving stocks, or the momentum factor, low volatility stocks whose price variation is small relative to other stocks, and high quality stocks. And this is just a few of the many hundreds of factors which researchers have identified. Farmer and French have made their data available so that you can download it from their website. And in this chart, I'm just looking at the outperformance of value stocks versus growth stocks. Value stocks are the ones which are cheapest by some kind of measure, in this case by their price to book value. And growth stocks are companies which are growing quickly. For example, that might be a tech stock with a rapidly growing turnover. And this is data stretching all the way back to 1936. And the grey bars are recessions in the United States. Now what you can see is that value has consistently outperformed growth. One explanation for this might be that people simply overpay for growth. It's easy to get caught up in the excitement of a company like Netflix and to overpay for its stock, whereas an undervalued plodder on the S&P 500 may not be as exciting and people will underpay for that. Whatever the reason, you can see that the outperformance of value has been fairly consistent for almost a century. You can see I've blocked out part of this graph. And the reason for that is a very shocking change in behaviour. Since the global financial crisis, you can see that value has underperformed growth, and this is a very unusual trend. Vanguard in the UK has made 4 factor funds available, and here you can see their outperformance versus MSCI World. Blue indicates cumulative outperformance, and red indicates cumulative underperformance. And you can see this very rapid fall in the outperformance for value over 2019. So there are no signs as yet that this sharp underperformance of value is turning around. So why is it that value is now underperforming? There's a great paper by Sean Markowitz, who works for Schroders Asset Management, which was published in December 2018, called Where's the Value in Value Investing? And he tries to make sense of this turnaround in value. He starts off comparing earnings growth for the MSCI USA Value Index compared with previous business cycles, and the values scale to be 100 at the peak of the previous business cycle. And the post-global financial crisis line is the one in light green. Notice how it never really recovers much above that 100 line, even to the present day. Whereas in previous cycles, earnings growth did recover at this point in the cycle. If we contrast that with the MSCI Growth Index, you can see that the earnings have recovered in this cycle. And because prices tend to track earnings growth, it seems that this might be the reason why value has underperformed this time around. The shape of the US yield curve also has an effect on the performance of value. When the term spread is rising, in other words the yield curve is steepening, value tends to outperform quite strongly. But if the yield curve is flattening, as it is recently in 2019, that tends to be a big drag on value. One of the reasons for a flattening of the yield curve is people pricing in lower long-term growth. And in that kind of environment, you put a premium on stocks which can grow their earnings. And of course, that's growth stocks, not value stocks. Another reason is based on the value of buybacks in the US market. Companies sometimes buy back their own stock. If you reduce the supply of something, in other words, you have less stocks around, while demand stays in place, that tends to drive up the price of the asset. And stocks are no different. If we reduce the number of stocks, you'd expect the price to increase. And you can see that since the global financial crisis, there's been a huge amount of share buybacks in the S&P 500. S&P Dow Jones Indices has done a breakdown of the number of buybacks by US sector. And if you look over the past 5 years, the US IT sector has bought back almost $800 billion of its own shares. And Sean Markovitz says that over the past 10 years, US companies have spent $4.2 trillion on repurchase programs, making them the single largest buyer of US stocks. And if we look at the breakdown of those buybacks for value stocks and for growth stocks, you can see that there's been a greater buyback activity for growth stocks, but that's not true of value stocks. So the greater scarcity of growth stocks compared to value stocks may explain their outperformance. And Markovitz also points out the outperformance is largely dependent on the sector composition of US growth, which is heavily dependent on IT stocks. So the natural question you can ask yourself is whether value will recover. I think the most likely reason for that would be if buybacks slowed down. As business cycles end, you get a lower rate of buybacks, and so that will no longer favour growth stocks over value stocks. Another reason is that growth is now very expensive. That may have been partially responsible for the sell-off in tech stocks in 2018, and that would tend to favour the much cheaper value stocks. Now, towards the end of 2019, earnings growth has slowed down, so I think it's less likely that this will be the trigger for the recovery of value, but it's certainly a possibility. And so far at least, the trend in 2019 has been for yield curve flattening, not steepening. So I don't think that's going to be responsible for a turnaround in growth versus value. But one thing to keep in mind is that during a recession, the outperformance of value tends to be smaller. And that's because it's a cyclical factor. It's very exposed to the business cycle. So if you are a contrarian investor and you're itching to get into value stocks, consider first whether we're likely to have a recession, because that could at least postpone the recovery of value. So although it's very shocking that we've had this massive shift from value to growth investing, it's unlikely that's going to turn around anytime soon, given the drivers. So I'd be very cautious about switching back into value if you're a contrarian investor, simply because the drivers are unlikely to favour that choice. If you found that video useful, please consider supporting us on Patreon. Just click on the buttons above. It costs just $5 a month, and you get to join us on Slack, and you get to join our live Sunday evening call. And I'd love to see you there. So, as always, thank you for listening.